5 seconds of silence?
All right, welcome everyone. Today we're going to dive into a topic that's fundamental to pretty much any business you can think of, receivables. In a nutshell, it's the money a company is owed. You could even call it the lifeblood of commerce because it represents the trust a business extends to its customers. And understanding how to report and analyze these receivables, it's absolutely crucial for figuring out just how financially healthy a company truly is. So here's our game plan. We'll kick things off by defining what receivables are and looking at the different types. Then we'll get into the nitty-gritty of handling credit losses because, let's face it, they happen. After that, we'll look at the more formal notes receivable, see how all of this gets presented on the financial statements, and finally wrap up with how to actually manage your receivables effectively. So let's jump right in with the basics. Okay, first things first. Let's lay the groundwork. Before we can analyze anything, we need to have a really solid understanding of what we're talking about when we say receivables and the different shapes and sizes they come in. I want you to put yourself in the shoes of a business owner for a second. You've made a sale, you've delivered the goods, but the cash isn't in your hand yet. What does that create? Well, it creates a claim, a legal right to receive cash in the future. And that right there is the very essence of a receivable. So the official definition is right here. Receivables are amounts due to a business. The most important thing to remember is that they are assets. They might not be cash right now, but they're expected to turn into cash pretty soon, which makes them a huge part of a company's financial picture. But as you'll see, not all receivables are created equal. The two big categories you'll run into constantly are accounts receivable and notes receivable. Think of accounts receivable, or AR for short, as your everyday informal credit. A business sends an invoice and it's due in, say, 30 days. It's simple. Notes receivable, on the other hand, are a bit more buttoned up. They're backed by a formal written promise to pay, they almost always include interest, and the payment terms are usually longer. We call these two trade receivables because they come directly from the company's main line of business. It's trade. And it doesn't stop there. Businesses often have what we call non-trade receivables. These aren't from day-to-day sales. We're talking about things like interest that's due on an investment, maybe a loan to a company officer, or even a tax refund owed by the government. It's really important to keep these separate on the financial statements so that anyone reading them can get a clear picture of where the company's money is coming from. All right, now for the real world. When you extend credit, there's an unfortunate truth. Some customers just aren't going to pay you back. It's a reality of doing business. So the big question is, how do we account for that? How do we reflect that reality on our books? Well, the proper way to do it is with something called the allowance method. And the key principle here, the big idea, is matching. We want to match the expense of a bad debt with the revenue it helped generate in the exact same period. We don't wait around for months or years to see who won't pay. No, we make a smart, informed estimate at the end of the period. This gives us a much more accurate view of our real profitability. Let's make this real with an example. So Hampson Furniture looks at its books and estimates that about $12,000 of what it's owed probably won't be collected. To get this on the record, we do an adjusting entry. We debit an expense account, credit losses, for that $12,000. Right away, that reduces the profit for the period. Then, we credit a very special account called Allowance for Expected Credit Losses. So how does this allowance account actually work? It's what we call a contra asset. It's an asset account, but it has a credit balance, so it works against the main asset. On the statement of financial position, you'd see the total account receivable, $200,000 in this case. Then, right underneath, we subtract that allowance of $12,000. And that result, the $188,000, that's the carrying amount. It's the company's best, most realistic guess of the cash it's actually going to collect. Okay, so time passes, and the company is now certain that one specific customer, R.A. Ware, who owes $500, is never going to pay up. We need to write off that account. Now pay close attention to this entry. We are not hitting the credit losses expense again. Why? Well, because we already did. We expensed it as part of our estimate. Instead, we debit the allowance account. We're using up a piece of that allowance, and we credit the specific accounts receivable for R.A. Ware. This cleans up the books, but, and this is the key takeaway, it has zero effect on the overall carrying amount. But wait, what if R.A. Ware has a change of heart and shows up with the money? It happens. When it does, we have a two-step process. First, we have to reverse the write-off. We put the receivable back on the books by debiting accounts receivable and crediting the allowance account. This is super important for keeping a good credit history on that customer. And then, step 2 is simple. We record the cash collection just like any other, with a debit to cash and a credit to accounts receivable. So, we've covered the ins and outs of your standard accounts receivable. Now let's turn our attention to its more formal cousin, the notes receivable, where everything is spelled out in a binding legal document. This timeline gives us a great visual of how a note works. On June 1st, Wolder Co. gives a $10,000 5-month note with 9% interest to Higley Inc. Now, a really important date here is September 30th. That's the end of Wolder's accounting period. Even though no cash has been received, Wolder has earned 4 months of interest, and that needs to be recorded. Then fast forward to November 1st, the maturity date, when the whole amount, principal plus all the interest, is due. The math for calculating interest is actually pretty straightforward. You just take the principal, multiply it by the annual interest rate, and then multiply that by the time period expressed as a fraction of a year. So for our Wolder Co. note, the total interest for the full 5 months is $10,000 times 9% times 5/12, which gives us a total of $375 in interest. Okay, let's put it all together and see the actual journal entries. On September 30th, Wolder has to make that adjusting entry to recognize the interest it's already earned. 4 months' worth comes to $300. So they debit interest receivable and credit interest income. Then, when November 1st rolls around, they collect the full cash amount, $10,375. That cash payment clears out the original $10,000 notes receivable, it clears out the $300 interest receivable we just set up, and it recognizes the final month's worth of interest income, which is $75. We've done all the hard work behind the scenes with journal entries and calculations. Now, how does this all get packaged and presented to the outside world, to investors, to lenders, to anyone looking at the company's financial reports? Well, there are some very clear rules of the road here, and they're all about clarity. You have to identify and separate the major types of receivables. Anything short-term goes under current assets, long-term goes under non-current. Crucially, you have to show the gross amount of receivables and the allowance for losses. On the income statement, credit losses are considered a normal operating expense, but interest income is usually reported separately in the non-operating section. And that brings us to our final and perhaps most critical section, management. You see, it's one thing to account for receivables correctly, but it's another thing entirely to manage them well, to make sure they actually turn back into cash for the business. Effective management really boils down to a 4-step process. First, you have to be smart about who you extend credit to in the first place. Second, you need a clear, well-communicated payment period. Third, you've got to be on top of monitoring collections. You can't let overdue accounts just sit there. And finally, you must constantly evaluate how liquid your receivables are. In other words, how quickly and efficiently are you turning them into cash? So how do you measure that efficiency? One of the best tools in our toolkit is the receivables turnover ratio. This is a fantastic liquidity metric. What it tells you, basically, is how many times, on average, the company collects its entire accounts receivable balance over the course of a year. And generally speaking, a higher number is better. It means you're collecting cash faster. Here are the formulas you need. The turnover ratio is your net credit sales divided by your average receivables. Once you have that, you can easily calculate the average collection period by dividing 365 days by your turnover. Now, here's why this matters. If you're an analyst and you see a company's collection period suddenly jump from 30 days to 60 days, that's a huge red flag. It tells you they might be having trouble collecting from their customers. It's a vital sign of the company's operational health. And all of this leads us to a final, thought-provoking question. For any business, there's this constant tension. If you have a super strict credit policy, you might scare away customers and lose out on sales. But if your policy is too loose, you might end up with a ton of credit losses. So managing receivables isn't just an accounting exercise, it's a strategic challenge. It's about finding that perfect balance, that sweet spot that allows the business to grow while still protecting its cash flow.